The year 2025 presents a complex and uncertain economic landscape. Global growth is projected to be moderate, but significant regional variations persist. The United States enjoys a robust recovery, fueled by consumer spending and business investment. The Eurozone faces challenges from high energy costs and sluggish growth. China's economy is undergoing a period of transition with a focus on domestic consumption and sustainable development. Navigating this mixed economic environment requires careful consideration of various factors. Inflation remains a concern, prompting central banks to raise interest rates. Trade tensions and geopolitical uncertainties add to the complexity. Understanding these global trends is crucial for making informed financial decisions. Despite the challenges, there are also opportunities for growth and prosperity. Innovation and technological advancements continue to drive progress, creating new industries and jobs. The shift towards sustainable and inclusive growth presents opportunities for businesses and investors alike. By staying informed and adapting to changing circumstances, individuals can position themselves for success in the years to come. In the following sections, we will delve deeper into the key economic indicators and trends shaping the global economy in 2025. We will explore their implications for personal finances, providing practical advice on navigating the challenges and capitalizing on the opportunities that lie ahead. Global GDP growth in 2025 is expected to be moderate, reflecting a world economy still grappling with the aftermath of the pandemic and geopolitical tensions. The economic landscape is marked by a series of complex challenges and opportunities that vary significantly across different regions and sectors. The International Monetary Fund projects global growth to be around 3.5%, a rate considered below the historical average. This projection underscores the uneven recovery and the persistent uncertainties that continue to affect global markets. However, this figure masks significant variations across different regions. While some economies are bouncing back strongly, others are still struggling to regain their pre-pandemic momentum. The United States, having emerged from the pandemic with a strong recovery, is projected to experience robust GDP growth of around 2.8%. This growth is a testament to the resilience of the American economy and its ability to adapt to new challenges. This growth is driven by strong consumer spending, fueled by a tight labor market and pent-up demand. American consumers are once again opening their wallets, contributing significantly to the overall economic activity. Business investment also remains healthy, supported by low interest rates and corporate tax cuts. Companies are investing in new technologies and expanding their operations, further bolstering economic growth. However, inflationary pressures and supply chain disruptions pose risks to the U.S. economic outlook. Rising prices and logistical challenges could potentially slow down the pace of recovery. The Eurozone, on the other hand, faces a more challenging economic environment. The region is dealing with a combination of slow growth and high inflation, creating a difficult scenario for policymakers. High energy prices, driven by the ongoing conflict in Eastern Europe, continue to weigh on economic activity. The cost of energy is a significant burden for both consumers and businesses, affecting overall economic performance. Sluggish growth in major economies like Germany and France adds to the concerns. These countries are key drivers of the Eurozone economy, and their slow recovery impacts the entire region. The European Central Bank's efforts to combat inflation by raising interest rates could further dampen growth prospects. Higher borrowing costs may lead to reduced investment and consumer spending. The Eurozone's GDP growth is projected to be a modest 1.2% in 2025. This subdued growth reflects the numerous challenges the region faces, from energy prices to structural economic issues. China's economy, the world's second largest, is undergoing a period of transition. The country is shifting its economic model to ensure long-term sustainability and reduce reliance on external factors. After decades of rapid growth fueled by exports and investment, China is now shifting its focus towards domestic consumption and sustainable development. This strategic pivot aims to create a more resilient and balanced economy. This transition is leading to slower but more balanced growth. The emphasis on sustainability and domestic markets is expected to provide a stable foundation for future development. The Chinese government is also grappling with challenges such as a property market slowdown and rising debt levels. These issues need careful management to avoid potential economic disruptions. China's GDP growth is projected to be around 5.2% in 2025, a significant slowdown from its double-digit growth rates of the past. This new growth rate reflects the country's evolving economic priorities and the challenges it faces. Inflation continues to be a major concern for the global economy in 2025. The issue has been a persistent thorn in the side of policymakers and economists alike as they grapple with the complex factors driving it. After surging to multi-decade highs in 2022 and 2023, driven by supply chain disruptions, pent-up demand and rising energy prices, inflation has become a focal point of economic discussions worldwide. Although inflation has moderated somewhat, it remains above the comfort levels of central banks worldwide. This persistent inflationary pressure is causing significant concern among financial institutions and governments. The persistence of inflation is prompting central banks to maintain their hawkish stance, raising interest rates to cool down economic activity and bring inflation under control. This approach, while necessary, is not without its risks and challenges. In the United States, the Federal Reserve has been aggressively raising interest rates since early 2022. This aggressive stance is part of a broader strategy to rein in inflation and stabilize the economy. The Fed's benchmark interest rate, the federal funds rate, is expected to reach 5.25% by the end of 2025, its highest level in over a decade. This significant increase reflects the severity of the inflationary challenge. These rate hikes are aimed at curbing demand and bringing inflation down to the Fed's target of 2%. However, the impact on consumer spending and business investment is a critical factor to watch. However, the Fed faces a delicate balancing act as it seeks to tame inflation without triggering a recession. The risk of over-tightening monetary policy could lead to economic contraction and job losses. The European Central Bank is also grappling with elevated inflation levels, albeit lower than those in the United States. The Eurozone's unique economic structure adds layers of complexity to its inflationary challenges. The ECB has been more cautious in its approach to raising interest rates, given the fragile nature of the Eurozone's economic recovery. This cautious stance reflects the need to support growth while managing inflation. However, the ECB is expected to continue raising rates gradually in 2025 to bring inflation back towards its target of 2%. This gradual approach aims to avoid destabilizing the already fragile economic recovery. China, unlike the United States and the Eurozone, is experiencing relatively low inflation. This is a result of different economic dynamics and government policies. This is partly due to weak domestic demand and government measures to control prices. The Chinese government's interventionist approach has helped keep inflation in check. However, China is not immune to global inflationary pressures, and rising input costs could push up consumer prices in the coming months. The interconnected nature of the global economy means that no country is entirely insulated from these pressures. The People's Bank of China is expected to maintain a neutral monetary policy stance, providing support to the economy while keeping an eye on inflation. This balanced approach aims to sustain economic growth without letting inflation spiral out of control. Trade tensions, a defining feature of the global economy in recent years, continue to cast a shadow over the outlook for 2025. These tensions have not only affected the direct participants, but have also had ripple effects across various sectors and regions, influencing global trade dynamics in unforeseen ways. The trade war between the United States and China, while somewhat abated, remains unresolved, with tariffs still in place on billions of dollars worth of goods. This ongoing conflict has led to increased costs for businesses and consumers alike, as companies struggle to navigate the complexities of the tariff landscape. The conflict in Ukraine has further disrupted global trade patterns, leading to sanctions and retaliatory measures that are fragmenting global supply chains and contributing to inflationary pressures. The geopolitical instability has forced businesses to rethink their strategies and adapt to a rapidly changing environment. The ongoing trade tensions and geopolitical uncertainties create a complex and challenging environment for businesses and investors. Companies must now consider a multitude of factors, from political risks to supply chain vulnerabilities in their decision-making processes. Companies operating in multiple countries face higher costs and logistical headaches due to tariffs and trade barriers. These challenges are compounded by the need to comply with varying regulations and standards across different markets. The fragmentation of global supply chains makes it more difficult for businesses to source components in finished goods, leading to delays and higher prices. This disruption has forced companies to seek alternative suppliers and rethink their inventory management strategies. Investors are also grappling with increased volatility and uncertainty, making it more challenging to allocate capital effectively. The fluctuating market conditions require a more agile and informed approach to investment. Despite the challenges, there are also opportunities emerging from the evolving trade landscape. Businesses that can adapt quickly and strategically are well positioned to capitalize on new market openings and growth areas. The restructuring of global supply chains is creating new opportunities for businesses in regions like Southeast Asia and Latin America. These regions are becoming increasingly attractive for investment due to their growing markets and competitive advantages. Companies are diversifying their sourcing and production to reduce their reliance on a single country or region. This diversification helps mitigate risks and ensures more stable operations in the face of global uncertainties. Governments are also seeking to strengthen trade ties with like-minded partners, leading to new trade agreements and investment opportunities. These agreements aim to foster economic cooperation and create a more resilient global trade network. Navigating the complex world of trade tensions requires businesses and investors to stay informed about the latest developments and adapt their strategies accordingly. Continuous monitoring and agile decision-making are essential to thrive in this environment. Diversification, both geographically and in terms of sourcing and production, is key to mitigating risks. By spreading their operations across multiple regions, companies can better withstand disruptions and maintain continuity. Building strong relationships with partners in different regions can also help businesses navigate the challenges and seize the opportunities presented by the evolving trade landscape. Collaboration and strategic alliances are crucial for long-term success in this complex global environment.